The Fed is the most aggressive I recall in decades. And there's one thing that can continue to upset equity markets, and that's the Fed. So you just don't fight it, no matter which way it's going.
We're going to see the beginnings of a recession end of this year. I think it's going to come sooner than most think. I think all of the conditions are right for it. Quite frankly, and whenever we've seen energy prices double with a tightening Fed and the inflation where it is, it's always led to a recession. And so I don't see any reason why this time will be different.
If the Fed acts as aggressively as they are anticipated to do, and as they are messaging that they will do, that they will launch us into a very deep recession.
Well, it's no surprise that the markets got destroyed yesterday, with all indexes, the Dow, S&P, and NASDAQ closing down almost 3%, whereas at the same time, AMC stock performed better than all of those indexes. Why exactly is that, and why is this such a bullish sign for the Moass? And potentially the Moass could be closer than you even realize. Now, that's what we are going to cover here in this video. How the volatility, how the pain in the stock market is actually a very bullish thing for AMC and the prospects of a short squeeze. Now, keep in mind, I am not here to convince you guys to buy, sell, or hold AMC. I've been very transparent with everybody here on this channel exactly what I believe is going to happen, when I think the Moass is going to happen, and why I don't care if you buy, hold, or sell. I actually encourage people sell if that's what they want to do, because that's going to be more dry powder, more buying power heading into AMC stock when the Moass actually does start. And after all, it will benefit the long holders of AMC, not quite the people that sell out. So we got a lot to cover. The work is cut out for us here in this video. The only thing that I ask of you is you hit the like button and subscribe to the channel if you guys learned anything out of this video. Rumor is that for every like button, we get closer to the Moass. So thank you guys for doing that. Now let's get to it. All right, guys, let's go ahead and point out the obvious. First things first here in this video. Now, what happened on Friday for AMC stock? We pretty much closed down about 2.3%. At the same time, the Dow Jones closed down 2.82%, S&P down 2.77%, NASDAQ down 2.55%, and the Russell 2000 down 2.55% as well. And you also seen a huge rush to safety with the VIX up 24.38%. So really, AMC performed better than all of these major indexes. That is a very rare thing in and of itself. Typically, there's not too many days where AMC actually performs better than every single index. Yes, the stock was red on Friday, and I know I get a lot of hate for saying that AMC is actually holding strength through this latest downturn, but it's the truth, and I don't care who likes it or who loves it. AMC stock is showing incredible levels of strength. Now, there's a couple reasons why that is likely happening. Likely because consumers are spending a lot of money on services. Lately, on a fundamental basis, a lot of your consumer discretionary stocks, a lot of your discretionary purchases, right? And if you guys are unfamiliar of the term discretionary, basically means if you could go get an HP laptop for $300, $400, $500, or go get a MacBook for $2,000, $3,000, well, the MacBook's going to be a discretionary item. It's something you want, but something you do not need. People are spending less money on those kind of items, but they are spending more money on things like services, going out to do things, going to restaurants, going to movie theaters, going on vacations, and that is about 70% of the overall GDP of America in the stock market in general. Services are actually much more important than discretionary stocks, discretionary items. So there's that. That's a bit of fundamentals of why AMC stock could be performing better than the overall markets. Same thing goes for other non-discretionary stocks like travel stocks, right? Dave & Buster's performing very well. Restaurant stocks performing decently. Airlines performing very well. So you got that. We understand. Now, when we're talking about the Moass, I think there's another aspect to this. I think there's the real possibility that a lot of people are actually stepping in and buying a lot more of those stocks that hedge funds have been shorting. Because if we go look at the Ortex data, the short sellers have not taken a break off of AMC stock. We can see on Friday, borrowed shares of 1.91 million, return shares of 1.55 million, borrowed change of 362.59 thousand shares. So it's very obvious there. Shorts have not took a break, but you do have these other fat aspects that are here in the background that are helping AMC stock hold up. But beyond that, we're also seeing a lot of option activity that is very bullish by the hedge funds and institutions. Over the past week, 108 orders totaling $106 million, positive order value of 75%. So it certainly looks like some hedge funds and institutional investors are betting that AMC stock will go up in the future. But now let's get back to the original question. How is all of this red, all of this pain in the markets actually a bullish thing for a short squeeze in AMC stock? Well, it comes down to the simple fact of go back to June when money was cheap. You can see back in January, the first rally for AMC stock, the bond rates, the 10-year treasury bond was at about 1%. In June, the bond rates were at about 1.5%. There was not really a lot of risk in the markets because demand was high, GDP was growing, the Fed was printing money. The Fed was your tailwind. They were pushing you ahead. They were basically encouraging you to buy risky assets because you couldn't get a yield really anywhere else unless you did that. So the Fed was basically encouraging this. They were saying, yes, go out, help out hedge funds, do what you got to do, make your money. We're not going to stop you. We're not going to restrict the liquidity. If anything else happens due to COVID, we will come in and save the day again. So that's why Citadel bailed out Melvin Capital, to name a very well-known example there. It happened across the board with hedge funds in January and in June when they got squeezed in their short positions, especially the funds that had too high of an allocation of their portfolio to those AMC shorts that really needed to get those bailouts. Any hedge fund in the world would step in and give them a loan for 5 or 10%. Well, because the system was foolproof. If you could get a loan from anyone else, a bank, even the Fed itself, at 1 to 2%, given where the bond rates were at that particular time, why would you ever not lend out money for 5 or 10% to help out a fellow hedge fund? That's what they did, and that's why a lot of shorts were ultimately not forced to cover, because everyone knows stocks go up, stocks come right back down. It's the simple fact of it. If you can just lend a hedge fund money to service their margin call and wait for the stock to go down and get paid out 5 to 10% or even more than that, why would you not do that? That's a no-brainer there. Everybody knows they go up and they come back down. The thing is, do you have enough capital to service that margin call like I just said, and can you wait out the storm? And that's exactly what happened. Some funds, yeah, they did get blown up if they had too high of an allocation to those short positions, but most funds didn't, and most funds were not forced to cover. Like we've talked about many times, the short interest only went down about 6% back in June. So what is different here? Well, we're really looking at a big problem in the markets. Besides just the economy slowing down, the Fed raising rates very aggressively, inflation very high, and all the geopolitical risk that we are seeing, you also see margin debt that is still at about $800 billion. It's only went down about $35 billion from the peak. So there's a lot of margin debt outstanding. What's been happening with the treasury yields? Well, they're almost at 3% now. So money is not free. For that same loan to bail out hedge funds, you're going to need at least 15 to 20% to make that even plausible. At the same time, not as many hedge funds or banks or other individuals with a lot of money, we're talking multimillionaires, billionaires, would be willing to come in and bail out these hedge funds that do get squeezed and will be squeezed when the Moass happens. There will literally be a lack of people willing to give capital. Why? Because you can get a 3% yield from the government. You're not going to go do a risky loan with a hedge fund for anything close to 3%, given how much risk is currently out there. Now, the short sellers of AMC, they own bonds, they own stocks. Well, what has happened in the bond markets? Well, you could see with the 10-year Treasury, TLT, it has went down from 154 back December 2021 all the way down to 118.67, almost just hit a new all-time low on Friday. They've kind of based out a little bit at about $119, $120, right, for these bonds. And that's a substantial decline. That's like a 35% decline just from where we were back in December. And if you guys are unfamiliar of this, hedge funds, institutional investors, they usually try to de-risk some of their portfolio by not only owning stocks, they also own usually about 40% bonds, 60% stocks. It can vary from hedge fund to hedge fund. Some are all stocks, some are all bonds, right? Generally speaking, 40-60 is a good rule of thumb. So they've lost on their bond positions. Their bonds' notional values have went down dramatically. So that is less capital, less collateral that they can actually use to service those margin calls and to keep their margin maintenance levels up. At the same time, the average stock in the NASDAQ is down over 50% from its all-time highs. So what does that also mean? That is less collateral, that is less capital to service those margin calls. Well, now we are at a very critical level where imagine what I just said, right? Capital is a lot more expensive. It's risky. We're talking about the odds of a recession here. The last real recession we had was 08, 09. Minus COVID, that was a very brief recession and an artificial recession. This, one would argue, is also an artificial recession due to the money printing and then the contraction or the eventual contraction of the economy. But nonetheless, we're talking about a recession. We're talking about higher rates. We're talking about a Fed that is not your friend, that is coming in and going to rain havoc on the stock market. Capital is not going to be scarcely lent out and bail out these hedge funds. At the same time, these same hedge funds with short positions are dramatically losing value in their stock portfolios, in their bond portfolios. So what does that mean? Well, it means that their margin levels have really went up, right? If you have, imagine this, if you have a $20,000 portfolio, $10,000 of margin debt, if your stock portfolio fell 50%, let's say you were all in on a stock that's went down 50%, say you were all in on Fubo, all in on AMC, well, you have already seen a margin call. Hedge funds are a little bit more diversified than that. Typically, they're not all in one stock, but the same principle applies. If you had $20,000 in your margin portfolio and you had $10,000 of margin, your portfolio dropped 50%, boom, you hit a margin call. So that's kind of what has happened in these hedge fund portfolios as well. That does not mean they just jump to rush to cover on their short positions. No. Actually, the opposite. They might add to their short positions. But what it does mean is as their stocks and their bonds are going down, they have that less collateral. Their margin levels go up. So when they start to lose on a short position, like AMC, they have to be a lot faster to cover on that short position because then they risk the fund. Because your stocks, your bonds are going down, the last thing you want is your short positions to also go against you. It's like, a perfect storm for short squeezes. It's really what you need to see to squeeze out all of the shorts or a vast majority of the shorts in a stock. Same thing like we've seen in Volkswagen, in Overstock, and multiple other stocks during 2008 without retail activity. Is what you're likely to face here in the near-term future. Now, I want to be very clear. Just because liquidity is drying up, everything we've talked about here in this video, does not mean it will automatically trigger shorts to cover. What it means is that even a small catalyst for AMC could drive us to that point where you do get a big rally, say another 45% day a month or two from now, when Apple comes down, when Google comes down, when Amazon comes down, because the fundamental numbers are just not as pretty and multiples have to get slashed, possibly in half. At the very least, about 30% by my own calculations. That's a topic for a whole nother video, but that means stock prices are going to come down even more. So if AMC does get a big rally, you're really going to see shorts start to pile on and cover on their short positions. Nobody's going to be there to help them. They have to get out now before shit really does hit the fan. And that's the snowball effect, where you get the small shorts covering because they are forced to. They have no choice. They will be forcefully liquidated. That's the difference between a margin call and a forced share liquidation, just so you guys are aware. A margin call is when you get margin call, think about it like an actual phone call. They call you up, say, hey, we need $1 billion in your margin account, or we got to close you out of your position by the end of the day. They go, here, take that money. I don't need it. Everything's going fine. Stocks are going up. We got plenty of collateral, right? Take these bonds. Take this Apple stock. Service that margin call. It's fine. I'll wait out the storm. Well, when you don't have as much money to do that, and it's really coming down to the wire, you go, hey, I'll just cover on that short position. If I get a margin call, I'll cover on it. I'll take the loss. I'll get out now while I still have a fund. Because when a margin call turns into a forced share liquidation, it's because you don't meet that margin call. That's where you start to take big losses. So it's a snowball effect that affects the small hedge funds, then the medium hedge funds, then the large guys. And the large guys, and really the upper end range of the middle liquidity hedge funds, that really will make the biggest difference to AMC. Those are going to be the guys that have millions of shares that are sold short, that are going to be covering in a very massive way. In my opinion, you're not going to see enough people actually willing to sell to stabilize that out. I think once shorts start to actually cover, it's going to be a massive effect. There's not going to be enough stocks to actually cover due to a lot of these synthetics as well. That could be a main key in this, and you will see the stock drive up to astronomically high levels. Now, my time frame for all of this, I'm being pretty conservative. I feel like the end of summer, fall time, you're really going to see capital very scarce by that time. Rates are going to be close to 2.5%, 3% by that time. So that means your bond rates are going to be 4.5%, 5% by that time frame. Stocks are likely going to be through the floor because investors are going to be pretty shocked at the numbers that are coming out, especially this quarter. And in my personal opinion, that Q2 is not going to be very pretty. Q3, not going to be very pretty. Q4, not going to be good. Looking at Q1 or Q4 for 2021 versus Q4 for 2022, there's going to be real concerns of a recession. So hopefully all of this made some sense, you guys. It's what I've been saying for months now. I know it's kind of rehashing a lot of what I have said in the past, but I want everybody to fully realize where we are currently at with AMC stock. Now, I think that's a big reason as well why we are holding up so much. I still think there's a lot of people that are continuously buying AMC, a little bit less of that short activity, but you're still seeing shorts and the short interest continue to climb and shorts piling onto those short positions. All in all, I am very bullish on what is going on, especially when you see AMC stock holding up so well on these very red days. So that is going to be all for this video. Let me know if you guys have comments, questions, or concerns down below in the comment section. I would love to answer those over this weekend. Now, in fact, considering what is going to be happening next week with all of these huge earnings, you got Apple, you got Amazon, Google, Microsoft, all of these large players that control the markets, it's going to be very, very volatile. If you guys want to come learn my trading strategy around earnings, that in my opinion is the best strategy to limit your risk, limit your potential to lose money, but also maximize your potential to make money, come join us in the trading group, link down below in the pinned comment. Coming on Monday, I have to up the prices. The value is so cheap, and I really want to make it a core group of traders. I want to make it, where it's not as accessible, if that makes sense. Yes, I want everybody to get the knowledge, but if you're not going to take it seriously, if you're going to be, in and out and you don't want to learn these things, then there's no point in being over there, because this is truly a long game. You can make a lot of money trading in this way. You can also lose a lot of money. So, not financial advice. Do what you guys got to do in that regard as well. If you don't want to touch options, probably not the best thing for you guys to do. If you do, if you like the potential there, you want to make a lot of money with options, or potentially make a lot of money with options, come join us in the trading group. That is going to be all for this video. Thank you guys for watching. Enjoy the rest of your weekend, and I will see you in the next one.